Welcome to the Real Estate Podcast with Robert Ikard, your premier hub for all things real estate, proudly hosted by myself. And join us as we delve into the latest news and trends shaping the industry, engage in enlightening conversations with experts from across the globe, and explore a diverse array of real estate topics. Additionally, anticipate concise information videos tailored to enhance your comprehension of various aspects of the real estate domain. Get ready to expand your knowledge and stay ahead of the curve in the dynamic world of real estate. As a reminder, I am based in the Dallas-Fort Worth area and boast extensive knowledge of the local market. Should you require a real estate representative or seek assistance with commercial or residential leasing or purchases or sales, please don't hesitate to reach out. Furthermore, if you're interested in being a guest on the podcast or know someone who would make a great guest, please contact me via the website robertikard.com. There you can also find links to podcasts and articles under the topic Real Estate Investing with Robert Ikard. If you're watching on YouTube, don't forget to hit the like and subscribe buttons to receive notifications of future podcasts. Welcome to a exciting new edition, and we'll introduce the special guest in just a moment. I just wanted to go over some real estate news that caught my attention over the last not long in the past here, beginning with a Market Watch article. And it said that economists doubt a doom loop will hit office real estate. Now, being an election year, you never know what is being said or what you can believe that is printed out there. But I can just say from personal experience, we do handle offices, office towers, and things like that. And I think when people see that working from home, you can do a certain amount of work remotely, if you're pure remote, for example. But if you are seeing that a person who has an office is going to lunch with people, they're mixing it up in the building with other people, they have an office that people can come to, and they may be doing more deals than you are as a result of having an office presence. That I think is going to start to get people's attention and bring things back to more normalcy as well. In the Dallas Morning News, it says fewer multifamily construction projects expected to get underway in 2024. Saudi Arabia in the Daily Mail unveils a vision for ultra luxury upside down skyscraper built inside a 1,500-foot mountain and accessed through an underground canal as part of a £1 trillion project for a futuristic city. So that's worth reading. That's an interesting read. I have another article by Celia Fernandez saying the number one state Americans moved to in 2023 is not Florida. Florida is number 2, and the number 1 state is Texas. For the 6th time in 8 years, Texas was the number 1 growth state. So that's interesting. So I have a list here in the article. It says Texas, Florida, North Carolina, South Carolina, Tennessee, Idaho, Washington, Arizona, Colorado, Virginia. I'm sure that's constantly a moving target. Another article is in Yahoo Finance by Angela May, dated January 31, 2024. It says, I'm a real estate agent and 8 things buyers should always do at an open house. One of the main things I got from, and that's an interesting article to read. I don't want to read the whole article to you, but one of the things it says is don't say too much to the agent who's doing the showing, because you may reveal too much information that you don't really need to, and it could affect your future negotiations. Another article, Dallas Business Journal, hundreds of apartments, retail planned in 225 million North Texas development. So as a part of a venture, Weitzman Company agreed to contribute roughly 12 acres of land west of the Kroger on Windhaven Parkway. So they're going to have a big development going up here. And another article is a Newsweek article, and shows China's economy is losing ground against the United States. So their economy is definitely slowing down, and their real estate sector has really been hit. It's, I would say, in crisis mode, and I've read further articles about that. But not to belabor that point. Anyway, moving on. Today, it's my pleasure to introduce our esteemed guest, Jonathan Reece, who currently leads the commercial lending division at Geneva Financial LLC. Jonathan is a distinguished national real estate entrepreneur, financer, investor, Main Street certified tax advisor, and international best-selling author. With over 27 years of expertise in both commercial and residential real estate markets, he offers guidance and mortgage solutions to homeowners, real estate investors, and business owners for the acquisition or repositioning of their commercial and residential real estate assets. As a Main Street certified tax advisor, he provides invaluable advice to real estate investors, self-employed individuals, and small business owners on wealth creation, tax saving strategies, asset protection, and debt structure and elimination. His company offers financing for a diverse range of property types, including investor multifamily, both 1 to 4 and 5+ units, owner, and the reason that's there's a distinction there is they fall under different categories. And Jonathan can maybe talk about that a little bit more in a minute. Owner user properties of all type, retail and retail strip centers, medical office condos, office buildings, mixed use properties, industrial and warehouse spaces, single tenant properties, blanket or portfolio loans, assisted living facilities, mobile home parks, hotels, churches, daycares, restaurants, gas stations, auto repair stops, and self-storage facilities. So they have a diverse range of property types that they finance. Their financing sources encompass commercial banks and non-bank lenders, investor financing, credit unions, life companies, and pension funds, private capital, SBA 7A and 504 loans, equipment leasing, invoice factoring, and PO factoring. They particularly focus on the luxury home market, catering to many of their business clients. Their product offerings include 90% loan-to-value jumbo loans, Fannie Mae, Freddie Mac, FHA, VA, HELOCs, non-QM lending solutions, construction loans, and private capital options for residential clients. Thank you very much for joining us, Jonathan.
Hey, Robert. It's great to be here.
So how are things in Arizona? It's here in Dallas. I heard it hit 90 degrees in February. Unbelievable, but true.
Wow. It's actually pretty gloomy here today. It's pretty overcast. We had a little sprinkles today, which is nice because we don't get them very often. So it's actually a reprieve when we get a little cloudy day here and there, because most of the time it's just sunny and blue skies here.
Yes. Well, that's nice. And so, Jonathan, tell us a little bit. I know I just read a lot of the nuts and bolts, but tell us a little bit about yourself, if you don't mind, to share with our guests.
Sure. Well, I've been in the business 27 years, and I've been in the mortgage banking brokerage, side for 27 years, primarily outside of simultaneously being a vice chairman of a bank in Tempe from 2001 to 2008. So, basically just been in the lending business for a long time, and we're basically we're kind of a super broker in the sense that we have relationships with a lot of conduit lenders and so forth in the secondary market that allow us to get products that are not readily available to a lot of the borrowers and investors out there in the market, just going to a local bank. So that's the value that we bring to the marketplace, is that we have access to numerous different capital sources from around the country. And, as opposed to a borrower coming to a bank and, applying to one bank and the bank saying yes or no, we have an opportunity to take a loan package and put it together and, put it out to 5 or 10 different investors, or know exactly from our portfolio who the investors are that will fund that deal, and get them 5 or 10 different options to choose from. So that's the benefit of that we bring to the marketplace, and that's what I enjoy about the business, is that we add value. We add massive value to people looking for capital in the marketplace, and that's why I've enjoyed the broker space for so long.
Well, that's great, and it's really good to have like access to multiple avenues, especially in this interest rate environment, wouldn't you say?
Oh, absolutely. It's very, very volatile, and there's banks in and out of the market all the time, and their portfolio changes, their portfolio saturations change. And so it's important to know who's buying in the market and who's not, and who's being aggressive in the market and who's not. And that's really a big dependent factor is whether that bank has a saturation in their portfolio of a certain type of asset class. So, knowing that just is our expertise, and knowing who and who's actively lending in that space, whatever type of property we're looking at, understanding who's in that space and who's most aggressively lending in that space to get them the best possible rate in the marketplace, today.
Right. Well, I want to talk about rates. One thing I was just looking at, I glanced over the introduction to you, and I thought I read somewhere that you all are the number one lender in Arizona under some category. Did I leave that out?
Yeah, no, that's part of a post we made recently. Our CEO put that out not long ago, and we posted that out. It's let me just check that. We get awards it seems like every month. So we're a fairly large mortgage bank. We're in 48 states of the 50 states, and we provide lending in all 50 states commercially and 48 states residentially. So we're number one ranking in Arizona mortgage lenders for 2024, 4 years running. So the last 4 years, we've been the number one lender in the state of Arizona.
Wow.
So
that's not an easy achievement, I'm sure.
Yeah, no, it's not. I mean, we've been around the block for a long time. A friend of mine, Aaron, started the company in 2007, right before the big mortgage recession. And, he white knuckled it through the mortgage recession and stayed alive and stayed afloat. And he runs a really good company. And it's a really good platform for our LOs to work on or work under and be successful.
Well, how big is your company?
I think we're about 150 to 160 branches in 48 states, and we probably have anywhere from, it changes all the time. LOs come and go on a regular basis, and it's probably between 700 and 900 loan officers around the country at any given time. So yeah, we're fairly big. Now, my role is I'm the national director of commercial lending for the company. So I run the commercial division. And so the majority of our LOs are residential lenders, right? They loan on residential 1 to 4 properties primarily. And so any commercial opportunity that they get on a commercial asset will come to me, and it'll let me, I'll be allowed to review it and kind of see if we can place it somewhere based on the parameters. I have a streamlined process that they submit the deal to me through, and allows me to analyze it very quickly and get them back a quick answer. So that's my role, as well as doing residential lending. I'm licensed personally in 22 states residentially, so I do residential lending in 22 states, and my team is licensed in the other 26 states that I'm not licensed in. So we cover the whole country primarily residentially, but I also do the bulk of the commercial lending for the company as well.
I have so many questions for you.
Sure, fire away.
Okay. So you all, let me just go through some of the questions that I have. And thank you for that update about how good your company is doing and the size of your company. That's very interesting knowledge for our viewers and listeners, because there's people that are looking for your services like you offer. And of course, I focus mostly on commercial real estate, not that we don't deal with some residential as well, but and then that's your main focus. So let me back up a little bit. I know we talked last week and you were telling me about some of the deals you're currently working on. Would you mind kind of just as a further introduction and for the guests, tell us what kind of deals you are working on?
Sure. Well, we're working on a rehab deal in the state of New York right now. It's a single family rehab deal. I'm working on actually a 401k loan, a non-recourse 401k loan on a commercial property, which is, a unique product, in by itself. So we're also working on
I
a.
don't mean to interrupt
Sure.
you, but before we move on, can you explain to our listener? I mean, this is we have many listeners that are just getting their start in real estate, and could you
Got it.
explain what that means to them?
Well, if you have a buyer that understands that you can invest in real estate with your retirement plan, that allows those retirement plans require a non-recourse loan because you're not lending to the individual, you are lending to a retirement plan, whether that be a 401k or a individual retirement account known as an IRA, right? So those loans are a specific type of loan that there are very few banks around the country that do that. There are a handful of banks that do it, but as a broker, I have relationships with most of them around the country, which I help streamline the process to find them the type of financing they're looking for, in a more expedient manner. That's kind of the value that I add to the process. So we work with a lot of people that invest through their retirement accounts into real estate. That's a big part of what we do. So that's kind of what that loan is. It's a loan to a 401k that actually owns a piece of real estate. And so we're doing a cash out loan on that property for the borrower to put them in a better situation.
Well, and many people do not realize they can use their 401k and their IRA. I mean, I'm sure there's a lot of rules involved, but many people do not realize they can use it for real estate.
That's right. That's right. That account has to be self-directed. There's a lot of caveats around that, and they can reach out to me and discuss that with me. I know all the ins and outs and how to set that up if they need to. So yeah, I mean, that's something we work with on both sides. Yeah, on both sides.
That's awesome that you can bring that knowledge to the transaction.
Yeah,
because that is a very specialized area.
It is, and I've been doing that for a long time, and just kind of a testimony to that respect is in 2009, my wife and I funded a LLC with we have 3 IRAs, a Roth and a traditional IRA, and my wife's Roth IRA, and so we funded an LLC that we bought a piece of real estate in, a single family residence, back in 2009. And if you remember what the market was like in 2009 across the country, it was very depressed, right? So we were able to buy a property for $72,000 in our retirement account. And we were able to recently sell it for $340,000. So nice. Great return. Yeah, it was a great return. But the best thing about that, Robert, is that it was tax-free, right? It all goes into the IRA. I can't use it.
That's an excellent point.
Right? I can't use it right now. I can use it later, but I can't use it now. But when I get it out, it's either taxed if it's in a traditional account, or I get it tax-free if it's part of the Roth account. So, it's really a great tool. And for those of your listeners that don't know how that works, maybe we can have another call just specifically on self-directed accounts and how they work. If you'd like to do that in the future, we can definitely do that.
I love that idea, because one of the things that we try to focus on are, many people think, oh, you have to be wealthy to invest in real estate. Well, they don't even think that their 401k or their IRA funds can go into real estate. And many times it can provide, not that there's no risk to real estate, and I'm not trying to tell people how to invest their retirements, or, I don't try to push anything on anybody, but it's important that people know that they have options. And real estate, to me, I have a strong bias towards it, but it can be a very, well, like what you did. You bought in a very down, depressed time. And what is that? Hundreds of % return on your investment?
Right.
Think about it.
Right. Exactly.
But anyway, I'm sorry, I will go off on tangents.
That's okay.
So anyway, you were telling me some of the deals you're currently working on before you were so rudely interrupted.
Yeah, no worries. We have a preschool deal in Florida, in Key Largo, Florida. We have a childcare deal in California. We have a Jiffy Lube deal in California. We have a Comfort Inn hotel deal in Texas. We have a 6-unit property in Illinois. We have, it's just a number of deals. We just closed a big ground up construction, 10,000 square foot warehouse deal in north of Dallas. Um,
Oh,
Another
really?
daycare deal, a dental practice deal in Frisco. Yeah, so they're just across the board and they're across the country primarily. So,
And very diverse range of uh real estate types.
yeah, the thing is that if it's real estate and it's commercial or it's residential, we can lend on it. I have capital sources that can fund those deals.
Right.
Um, and if you can't find the deal at the local bank, if you've been turned down 2 or 3 times, that's really our ideal client to help them find capital to fund their real
Yes.
estate deals. That's our forte. That's our strength in the marketplace, and that's the value that we add.
Well, not to get on too much of a topic of banking, but
Mhm.
banking is it's in a strange world right now. I mean, I know that you source funds from banks, but as far as banks in and of themselves, I mean, can you share anything with our audience about what your knowledge is of what's going on?
Oh,
Um,
sure.
Go ahead.
Well, I think banks in general are under a lot of pressure right now. There's a lot of saturation of multifamily in a lot of banks' portfolios. And if you watch the headlines or you watch CNBC or you watch any financial news, you've heard it over and over in the recent weeks regarding NYCB or regarding commercial office. And I think I sent you that article regarding commercial office conversions. You're seeing a lot of reappropriation of commercial office because, as we know, and as you talked about in some of your article reads in the beginning, that there's this transition from people working from home as opposed to the office, and so they have a need to make use of that office space that's no longer being used for office, and so there's a lot of conversions happening. But banks in general are unsure of what the future holds for a commercial real estate. And I think there's $1.4 trillion worth of commercial office or commercial paper coming due for renewal this year. And
Wow.
the issue is you have commercial office and multifamily. And the issue you have is that a number of these projects were brought out of the ground. They're not to market yet, so they're still under construction, and they're under construction at the ZIRP rates, which is 0% interest rates. Basically they finance those
Right.
at 2-3%. And now when these builders and these developers have to restructure this debt and put permanent financing on it, not only are they going from 2 or 3% to 7%,
Or
they have
worse.
they have a valuation issue because those properties they're not all leased up yet, and so they have a valuation issue, and so a lot of these developers are having to write large checks in order to put permanent financing on their properties because the value is not there and the cash flow is not there, and they're also going from 3% to 7%. And so if a developer is in a situation where they don't have capital and they can't raise the capital, there's a projection that some of these properties will end up going back to the bank. And so there'll be an opportunity over the next 12 to 24 months for some distressed projects to be picked up by other investors if you're an investor at that level. Both small and big, I think you're going to find across the board, across the spectrum, both types of developments that are going to be available. So if you're an investor out in the space, I would say be patient. A lot of things in the marketplace that I'm seeing on a regular basis, a lot of multifamily that I see is still way overvalued. They're not cash flowing. I see a lot of deals that the sellers are still trying to sell on a pro forma basis, which means they're trying to sell it based on what your rents will be next year or 2 years or 3 years down the road. And banks don't finance on pro forma. They finance on historical data. They will finance based on the rents that you have today and the cash flow that you have today, not what you'll have next year. And a lot of investors don't really understand that. They don't get that. They see the value down the road, and they see the value maybe for their retirement down the road and the cash flow that it might bring. But they're going to have to put up money now to get into that building to take advantage of those benefits. There are some great values out there still with pro forma rents. And if rents continue to increase and values continue to increase, they'll be in a really good situation in 5 years. But today, when they want to finance that property, they're going to have to finance it based on historical rents. And I just ran a deal today. I ran 2 deals for the same gentleman he's looking at. And both of these properties with current rents only would finance a 50% loan to value loan at today's rates. So he's trying to get into a property with 20 to 25 to 30% down, and they're just not financeable at the current market price. So that's the issue I'm seeing with banks and with lending in general, is they're being very conservative, and they're not going to go out based on pro forma of what the rents might be in the future based on current trends. It doesn't matter to them. It only matters historically what they've been in the past.
Well, and from a bank's perspective, a loan is an investment for a bank.
Yeah, absolutely.
And they also have the option of investing in government bonds. And because of that, well, that's actually biting them in today's environment, because
Some of them, yes, for sure.
as interest rates go up, bond values go down. But
Right.
so that's why a lot of banks are literally and probably actually underwater right now. And if they had to do mark to market, which most people do on their financial statements, which they do not have to do, they have an exemption where they can put on their financial statement which they purchased the bond at. I don't want to get too deep in all of that, but it would be there would be a lot of fear in the world if people really thought through all of that, what's going on.
Sure.
But on the other hand, banks are kind of quasi in with the government, and so they can't let them.
They're highly regulated, so they don't really have a choice, right? They're going to be regulated. They're going to have audits by the OCC and the FDIC, and their loans have to pass muster when they get audited. So they are under pressure by the federal government and the regulating bodies that regulate them in order to make sure that they're writing good loans, right? And loans that are going to perform. The other thing that some investors out there, you have a divergence between single family residence investors and commercial investors. And you have a lot of people trying to pass over that threshold from being single family investors and jumping in the commercial sector. And they're used to getting 30-year fixed paper on residential lending. And that's fine, because the 30-year fixed mortgages are backed by the federal government if they fit within the Fannie Mae and Freddie Mac guidelines. But commercial paper is not sold on Wall Street for the most part, right? It's held on bank balance sheets. And so those banks have to write good loans.
Otherwise known as in-house loans.
That's right. They're going to service them. They're going to have the relationship. They're going to have to collect on those loans, and they're going to have to foreclose if it comes to that. And so they're very conservative. Yes, right. Absolutely. And they want to make sure that they have a good borrower, a good business, if they're lending to a business that's going to occupy the property, or they have good tenants if they're lending to an investor, right? So you'll find a lot of banks are cut out investor lending across the board. They don't do any investment properties, only owner user properties. And they want to make sure they underwrite the business to make sure it's a solid business and they're going to be able to pay that mortgage going forward. The other caveat.
Let me stop you right there. When did this aversion towards investor lending begin, in your opinion?
I think, recently after the failure of SVB, I think prior to that, with the run up in the valuations,
and that was a big bank. That was a big bank in California, correct?
Correct. Silicon Valley Bank, Republic Bank, both failed. Silicon Valley got picked up by First Citizens, and Republic got picked up by, I think, J.P. Morgan, possibly. So they're adverse to the fact of investors because they think, and it's just proven, as I've mentioned about the couple deals that I reviewed just today, is that the valuations aren't there. I mean, we have trends of increased valuation, and we have trends of increased rents across the board, right? But nothing's guaranteed. So that's why we're looking at historical values. We're looking at historical rents over the course of the past year, 2, 3 years. And we're going to underwrite based on historicals. We're going to underwrite based on what your property made in 2023, not what you think it's going to make in 2025 after you do $200,000 in rehab. and up all your
Well,
rents on your renters across the board, right?
yes, and you know, I'm a real estate investor. I've been one for many years,
Mhm.
and you gotta, I mean, we look at things from all angles here. I mean, I know we're talking about mostly financing properties today, but what some of our guests may appreciate is that, for example, if I would go to a property and somebody said, well, say it's an apartment complex, okay,
Mhm.
multifamily.
Sure.
They said, well, these are the rents we're getting today. However, we're below market and we could be getting XYZ. And I just look at them and I'm like, no, that's probably not true. Probably what's true is you're getting what you can get. And
Right.
that's how you know, as an investor, you really got to be careful about that kind of talk. When somebody says, well, the market rents are here and we're making this and but with this and that, and you know, a lot of that is just salesman talk. And for our listeners, you got to be careful when you hear that. And that's what I always say. No, I look at a property, I'm saying, no, what you're getting today is probably what you can command, because who doesn't try to get as much as they can? And so anyway, that's just a side note, looking at it from a real estate investor perspective.
Sure. And I think the investors, I mean, you might be able to increase rents, but it's going to cost you some dollars. You're going to have to go
Right.
in and put in new flooring or new cabinets or new countertops and update each of the units. And people think that happens overnight. When you buy a property, so let's just say it's a 20-unit property and you have 20 tenants. You can't just go in there and update those units. That you have to get approval from the tenants, number one, or
Yeah.
you have to wait till the lease expires, and then then you have to coordinate that. So it may not happen in year one or year two, depending on the the lease expiration dates of all the tenants that you have in the property. That could take you 2 to 3 years, because I've done it. I've owned apartment buildings. I've had to do that. I've updated units over the time, and then we sold the property after we've updated the units. And so that is a model that works. But in this market, I guess one thing I'll throw out too is that if you look at not to get too much in the weeds about cap rates. I don't want to delve into that and define it necessarily, but cap rates are around 5% across on multifamily, and rates are at 7.5 for an 8 paper deal. So when cap rates are less than interest rates, you have a negative cash flow deal, period. So, and the other caveat is that if cap rates are at
Which
5%,
is exactly what's going on right now.
that's right.
I mean,
And
if the
look,
average cap rate is 5% and the average interest rate is 7, I mean, there's all kinds of stuff negatively cash flowing,
that's right.
correct?
And if you can go put money into a high yield savings account at 5%, why in the world would you ever buy real estate for a 5 cap?
Or yeah, or a CD or whatever, exactly, with no risk.
You know what I mean? Yeah. And yeah, there's benefits. Listen, I understand that there's other benefits of owning real estate, as far as paying down of principal on loans, of the depreciation that you are able to gather and offset, your ordinary income from depreciation from an asset like that. There's a lot of other value of owning real estate, but when it's so close to what you're earning in no risk, a no risk savings
Right.
account, it's really tough to justify that unless you're getting a good deal when you have a 7, 8, 10 cap, something like that.
Which
You
which is
know,
going to which is probably drying up a lot of the private money.
what do you mean by drying up?
Well, like an investor who may be wanting to go out and invest, they're looking at that trade-off. You look at a
Mhm.
5% CD, which is I mean, you can get rich at 5%.
Yeah, over time, for sure,
Yeah.
absolutely. Compounding
Um,
interest is a real thing.
yes, it is. It's a big deal. And with no risk, that compared to going into real estate. So that person right there, if they make the decision to go into a CD, that's money that's no longer on the real estate table,
That's right.
I guess is what I'm trying to say.
Gotcha, gotcha. So the question I had was simply because we do private money lending too. We have a large portfolio private money loan fund. We do individual private money lending. We have numerous other funds that we work with that we have direct underwriting access to. So the private money lending, returns 10 or 12% on capital when it's deployed into notes, right? Whether it's via fund or individual notes. So that was my question regarding the private money. The private money's there. But obviously, if you're buying a property, you can use private money, but obviously you're going to get a much lower loan to value leverage on that property than you would with bank financing at 7% versus like 12%, right?
So yes, correct. So at you as a loan broker, is that a
Mhm.
fair word to use?
Sure. Well, I mean, we're a banker we're a banker and a broker. Yep.
Okay, a banker
That's
and a
fine.
broker. Okay, so you have your own money too.
We do.
Your company, your bank. So you
Yes.
are a bank.
Yes.
You guys are a bank and you do have your own money, and then you also deal with outside funds.
We're a mortgage bank. We're not a depository bank, just to
Okay.
clarify that. We're just a
Okay.
mortgage bank. Yes.
Okay. So I guess where I'm going with that is if you're having you as a mortgage bank, you're seeing a lot of changes in the industry and with banking. And what is the most negative thing you're seeing right now? Is it rates?
Well, we don't really control rates. The Fed controls rates. The Fed controls rates, and we're in an election year, so really, no one really knows where rates are going to go in the next, 2 to 3 quarters coming up to the election, because there's a lot of manipulation done in the market with those, right?
Right.
Obviously, for purpose. So when you're buying real estate, you have to like get out of the rate matrix. You have to get out of rate being the issue. Either the deal makes sense or it doesn't make financial sense, right?
Right.
Whether the rate's 3 or the rate is 7 or the rate is 10 or 15%, like it was back in the late 70s, 80s. Real estate might still make sense even buying it at 12% if you're getting the right deal in the right location.
Right.
So every deal has to be analyzed separately, individually. So I think the biggest pressure is not necessarily rates, but you have the uncertainty of the market, right? Uncertainty of valuations, uncertainty of rents, of both commercial, multifamily. But I think if you're buying into the single family owner user, you're buying a primary residence for yourself to live in. I think that's the best investment you can ever make, as opposed to paying rent.
Right. So when you see as you see this new environment people are facing, and are you personally, I know you mainly do the commercial side at your company, at your
Well,
bank.
I do both. I do about equal amount of both types of
Oh, okay.
loans.
All right.
Yep.
Well, let's talk about commercial right now. Are you
Sure.
seeing, like, let's just say over the last few years, how has your business been as far as, and if it's, I'm not trying to get personal or ask,
No, it's okay.
I'm just asking, has it dropped off? What's going on? Give
No,
us
it's been
give us the report.
well, as a broker, we've been extremely busy. Lots of deal flow, lots of leads, lots of people looking for capital. But the expectation is not there for the people looking for capital. Like I said, the 2 deals I looked at today, people are expecting to buy these properties at 20% down, and they don't cash flow. They had negative cash flow at 20% down. Like the property example I gave earlier, the property is like worth 1.4. It was a 12-unit property. The property cash flow with a loan of $650,000. That's it. So 1.4 purchase price, he would have to put down, $800,000 to buy this property. It
Wow.
just made no financial sense. And most people don't have that kind of capital. Now,
Right.
if you buy that property cash, you're getting a 10% return on your capital. If all the payments are made and all the expenses stay the same as they are today, it's a good investment if you can pay cash for it. But once you
Right.
add leverage at 7, 8, 9%, depending on your credit score,
Right.
at some point it no longer makes sense, right? To be, stroking a check every single month to cover that debt service just doesn't make sense.
No.
So that's the issue that you have right now, is expectations of sellers and expectations of buyers.
Right.
They're so far apart right now. You're finding a lot of stalemates in the industry, right? So we get a lot of deal flow, but not a lot of deal flow that makes sense, that's financeable.
So has your business gone down, or is it?
No, I mean, we're still extremely busy. I mean, I have one. Now we have about 22 deals in the pipeline right now on the
Oh,
commercial
wow.
side, and on the residential side.
So I
have,
guess your challenge is kind of educating people up front as to the current challenges. And like you say, you may have to look at putting a tremendous amount down and here you are as a seller, they may need to start looking at dropping prices. I mean, that's really the only way they can go if they
that's
want to
right.
move if they want to move a
Well,
property, right?
that's right. If they want to sell to a property that's getting to a buyer that's getting financing, they shrink their buyer pool if they
Right.
don't make it, if they don't make it attractive and financeable to someone that's coming in with leverage to buy that property, right?
Right. And as the buyer
They might
pool
be,
shrinks, you better, I mean, yeah, you can hope for a cash buyer. Here in the DFW area, we get a lot of cash buyers. A lot of
sure.
cash deals are going on,
Yep.
tremendous
Yep.
amount. But not everybody can come up with $1 million cash.
That's right. That's right. And it might make sense for that person, but if they don't have $1 million, they have to use leverage, then it's a different story. And the expectations, what I try to do is I try to set expectations up front. When I
Yes.
see a deal, most importantly is to say, look, this is what you should expect in the marketplace.
Right.
Look for deals that you can finance 70% or less. If you need to finance them based on, current market, look, we'll analyze 100 deals if we need to before we find the right one. But, we're going to have to find one that's financeable and that's underwritable, and then it has to appraise. And so you have a lot of I guess the big caveat in the marketplace right now is the spread between the sellers and the buyers. Still, sellers still want too much money for their property, and buyers are expecting to put as little down as possible, and they just don't meet in the middle for financing. A lot of these deals, if you look at Fannie Freddie small balance loans or at Fannie Freddie multifamily loans, a lot of them are coming back at 50 or 60% max leverage. And you're talking about a $1, $2, $3, $5, $10 million multifamily property. And so someone coming into that property expecting to drop $2 million in a down payment on a $10 million property, and they have to put $5 million down as opposed to $2 million, it usually kills the deal, right?
Definitely will get your attention.
Yeah. Yeah. So we're seeing a lot of that. We're seeing a lot of things that are not doable. But you know what? It's a numbers game like any sales is. The more deals we see, the more deals we can do.
Right.
That's the bottom line.
Well, and yeah, I like I say, we just try to find out what's going on in the country and for the guests, because it's very interesting to them. Now, I've got some questions lined up here, but also as they hit me, I like to ask them.
Sure.
How is Arizona doing?
Arizona's doing good. I mean, Arizona's hot. Arizona's always one of those forward markets that's first in, and they take the biggest hit too when we crash. Like a Vegas, like in North Carolina, like
Florida.
Yeah, Florida's. The big markets are always the first in, the first up, and the first
Right.
down, right? But right now we're still pretty hot. Rents. I mean, prices are still going up. I still see some. I do see some softening in the prices because I'm on some feeds on a regular basis that look at local pricing and listings, and I see as they come over throughout the day, you see decreases in pricing. You only see $2K here, $5,000 here in evaluation, but they're lowering prices to try to find more buyers. And you see a lot more properties coming on the market recently. And obviously that's just a standard trend of the market, right? Residential properties in general, the big bell curve of real estate is it's very low in January and very low in December. And the high point is June and July when families are out of school and families are making moves. That's when all the transactions happen. Most of the transactions in residential real estate happen are in the middle of the year because that's when families move.
Right.
So just as a general rule, things are coming on the market because people were holding off until after the holidays to list their properties in the spring. And so you're seeing that as a general rule. That's the same every year. But you are seeing some softening in the prices. You are seeing more properties coming on market. And if the problem is that you have people that are the big buyers right now are owner users, are people that want to occupy those properties to live and grow their families in. You don't have a big investor pool buying into these properties because it doesn't make financial sense right now when you're paying $500,000 for a home and you can only get $2,500 a month in rent,
Right.
It doesn't make financial sense, right? So that's the issue that you have. But Arizona
But
in general is still pretty good. I mean, we everything's still pretty hot. We haven't really had a decline in prices at all. Rents are going up. Prices are still continuing to rise 2 to 3% right now on the annual adjusted basis right now. So
well, I know there was. I mean, I'm not really that connected with the real residential side of real estate,
sure.
and but it's my understanding that a lot of the market in a lot of the places now, maybe not in Arizona, maybe not. Well, I think it is here in certain places, but anyway, has just locked up.
Yes,
Can you elaborate on that?
I can. There's not a lot of inventory. For example, my wife's a commercial realtor, and we have a couple of co-clients that we work with that I'm doing the lending for, and she's looking for properties for. And the problem is there's really no properties here in Arizona because there's such a massive influx of people. In the commercial side, she's looking for industrial buildings, she's looking for office to purchase. And there's not a whole lot in the marketplace to purchase. You have a lot for
Same
rent.
here. Same here. Good luck finding that here either.
Yeah. And they're not big. They're not looking for 50, 100,000 square feet. They're looking for 5 or 10,000 square feet
Right.
or
Right.
3,000 square feet. And it's just
Mhm.
not out there right now. They can't find it anywhere.
Yeah. Well, I
You
mean,
can go to the way outskirts of town and find it, but you also want to buy in location based on where your client base is. And these folks it's really hard to find that type of property right now in Arizona. It's still really a hot market, locked in, not a lot of inventory on the marketplace in that space.
well, and I think one reason is also if you have a 30-year fixed loan at whatever, 3,
Mhm.
4%, um, you're gonna, even at whatever's going on in your life that might have been happening under the old rate environment, which was zero
Mhm.
forever. Um, Under that environment, people could do all sorts of things. They could say, I'm going to upsize, downsize, sideways size, whatever. But
Right.
now I think they're really thinking, wait a minute, I'm gonna sell my home. This is the dilemma I see here in Dallas in certain neighborhoods.
Mhm.
First of all, people can't even afford the house they're living in, right? Couldn't afford to go out and buy and finance the house they're currently living in because the prices have gone up so much.
That's right.
So that's one thing. And then also the rates have gone up. So therefore, if you sell your house and you're in a pretty good neighborhood and you want to go to a different area of Dallas or whatever, or the DFW Metroplex, you're going to get less home. You're going to get
You
less
are.
home and you're going to have to downgrade your lifestyle. So a lot of people are just frozen up because of that.
That's the residential side for sure. That's across the country. People that, I think 60% of mortgages are under 4%. So when rates are still at 7% and going higher as of recently, they went up again today.
They did?
People, yeah, about
What are
15
they,
basis
what are they
points.
at today?
The MBS bond market was up about 15 basis points. So they didn't like go up exponentially, but the yield went up 15 basis points. They're trending higher. That's
So
the
what are
point
they
is that,
at today?
oh, there's no market, there's no like basic rate, but let's just talk about national averages. I'll pull that for me 1 second.
All right.
National average as of yesterday was 7.13.
Wow. Wow. Wow.
That was as of
However,
as of as
However,
of
looking at the big historical picture, these
Mhm.
are not really as outrageous. It's just we've been spoiled by zero interest rates for a
We've
long
been
time, and
spoiled for
now,
18 years. Yeah, absolutely. I mean,
yeah,
the historically
exactly,
average is 6.5 to 7%. This is a normal market, I
right,
mean, because
exactly,
people don't they have short-term memories where they don't really remember when it
right,
used to be 17 and 18%. And a lot of people now, the millennials and the Gen Zs, never saw rates that high, when they were in the market.
right.
So they only know this low interest rate market. And so they're spoiled and they don't really understand why they're so high, but they're really not. Historically, being in the business for 27 years, historically, these are
Right.
average rates, right? These are normal interest rates, 6.5 to seven
Yes,
and a half
yes.
percent. And that's
Well,
usually
I've
a healthy
talked to
market.
people. Yes, exactly. I think you're exactly right. I've talked to people of that generation, and they're looking at what their parents are locked in at. A lot of them,
Mhm.
okay, or their friends or whatever, their older brother, sister, and they're saying, "Well, Jim, has a mortgage of 3.5%. Now they're asking 7.5. I'm not getting near that market. Well,
Right.
that's one way of looking at it. But like you say, a historical view of it is like we're at averages now. And I think if your goal, like you say, I don't know that you should really chase interest rates too much. If
Right.
your goal is to buy a home for your family and raise your family in a good neighborhood with good schools, um, and you can afford it, a couple of things I'm looking at
Mhm.
is, okay, you're gonna hold off for what? They may go up more.
That's right.
There's no guarantee. I mean, I know there has been talk about things. They talked about a lot of things, but right now, like you said, they went up today. So yes, they may drop them because of election or year or whatever. But the reality is I've told people, and I don't really want to tell people what to do. I don't. I like them to
Right.
make their own decisions. But I have told people, you know, 5 years down the road, what if they're still at 7? What if they're still at 8? Now
What if
you're
they're at
still
9?
living in an apartment and you've denied yourself a home that might have improved your lifestyle a lot.
But also the property is worth 5 or 10% more because you still have appreciation in property because there's no inventory. The prices are going to
Exactly.
continue, the supply and demand issue. So, that's the issue, is that if you're going to buy a home, if we're talking about single family residence and you're looking to buy a home, I mean, right now, if you buy whatever the rate is and you can afford it, then buy the right home for your family and with the right schools and the right location where you want to be. Because if and when rates drop, then you can take advantage of the refinance and lower the rate at that time and make it more affordable for your family. And you're still there, you're still
Exactly.
getting equity, you're still paying down the rate, right? But if you continue to pay rent, you're not building equity, you're not getting any interest deductions, you're not getting any depreciation or anything like that. So you should buy a home for your family. Now, as an investor, it's a little different story, a little different analysis that you have to make.
Right.
It's a cash flow analysis. And so the key thing is our economy is still on fire. And everyone was thinking, coming out in the turn of the new year, everyone was thinking, okay, rates are going to drop now after the first of the year. But as we've all seen with the PCE and the PPI coming out and the CPI coming out, and they're all hotter than ever, the Fed's not lowering rates anytime soon.
Right. And for
Now
the
they're
benefit
pushing
of
it
our
out to June
listeners
or
who are
July.
not, and for the benefit of our listeners who don't understand a lot of those acronyms, basically you're talking about inflation. And
That's correct.
inflation
Those are
is
the
still
inflation measures. Yeah,
cranking out. It's still very hot. And when the Fed looks at it as, if inflation's high, I mean their whole goal in raising rates is to tame that tiger of inflation. But if they see it still roaring inflation, they're not going to drop rates because that will fuel inflation.
that's right. That's right.
So those are different indexes for different inflationary measures
I
that
know
you
you told me to
mentioned.
stay away from acronyms too, so I apologize.
Oh no, it's all right. Don't apologize. I'm probably guilty of that myself, but we do have listeners of all different types of um experience that listen to this show. Okay, we are on this topic. So let me ask you this question. Let's say you're living in an apartment or something like that, or you're a rental. Let's just say a rental,
Sure.
and you want to buy a home, okay, and you have a good income and you could qualify. Okay,
Mhm.
what do you advise that young man or woman or couple um, to how do you advise them to get their ducks in a row to be prepared to enter into that transaction?
The first thing, obviously, is there's a number of steps you can take. I would say first find a good loan officer, whether it's myself or someone else in your market or someone else you know, or well, find somebody that's experienced in the business and that they have a plan for you to get yourself prepared to buy a home. You make sure your credit is correct. Make sure everything on your credit report is showing correct. Find out what your credit score is. Allocate or find out what all of your, where your savings is. Where's the money coming from that you're going to use for this acquisition? Your job history. Make sure you have that lined up. And then the key thing is, when I work with someone, the first thing I do is kind of have them go through the application process, because that gives me the baseline of where they're at. Whether they qualify today, 6 months from now, or 12 months from now, That's going to give me a baseline of where they're at. And then from there, I can give them the direction and the knowledge of what they need to do to prepare themselves. If they're not ready today, this is what you need to do. This is your game plan to put yourself in a position to buy in 3 or 6 or 12 months from down the road. And so the key thing is there's a number of things out available on the internet to look and how to prep yourself to buy a home. There's a number of steps to take financially to make sure that your records are in order, your documents are in order, your tax returns are in order, your pay stubs, your W-2s, your bank statements, all those things are in order. And most important, the two biggest things are obviously your credit score. That's a huge indicator of what your rate is going to be. And then how much capital you have, how much money have you saved for the transaction? Those are the two biggest factors when you're buying a home.
And maybe don't go out and buy a new car while you're thinking of this.
Yes, and don't take on any new debt, no new credit cards, no new car. Don't go buy a couch or a computer on 0% financing. And another big thing recently in the marketplace, you'll figure out, you probably, Robert, you've probably seen these headlines. There's a big influx and there's a trend up in this BNP, the buy now, pay later platforms, where people are buying now on credit, using Stripe and using Affirm and using these other buy now, pay later platforms, where it allows them to finance purchases over the course of, I think, 3 or 6 months at extremely high interest rates. So
right.
You see a big influx of that right now. And so you have that as part of the underwriting process. If you have a number of those types of loans outstanding, those are going to be seen by any underwriter now. And so you have to take in consideration that as part of your debt service of that payment that you have to make every month on top of what all your other payments are going to be, including your new home payment.
Okay, well, as a lawyer and a real estate investor on my end, and now also I do real estate leasing, sales, management. I've had a lot of people ask me, how do I find the right property to invest in? And I will tell them, like, oftentimes it'll be in the commercial zone that they'll ask me that question. And I'll say, well, I always advise people this, because this is what I did, is my first conversation is with the banker. Yes. And I want to know what I can afford, and I want to go in with a sober outlook on this whole thing. I don't want to go looking for properties and identifying properties and spinning my wheel and burning up all kinds of time and maybe real actual tires and all that. When you got to know, okay, I'll let you're the banker. You tell you, I think you know where I'm going with this.
Sure. I think the biggest thing is, when you have someone that comes with a question like that, I think the problem is you can tell from the very beginning that they're not an experienced investor, because an experienced investor will find a property and analyze it themselves to make sure it's a good investment for themselves, right?
Right.
So you deal with that and you understand you have new investors, and that's okay. It's nothing wrong with being a new investor. The key thing is I hope that you're on a plan or on some type of protocol to get yourself educated on investing in commercial real estate, right? Understand what it means, understand what a commercial lease is, understand how a commercial building works, whether it's a commercial office asset or multifamily or warehouse or mixed use or whatever it is. Understand how that property works, where the income comes from, where the expenses are from, look at what the blind spots might be for you in that property. So educate yourself. I mean, I can do a lot of education, but it's really, as an investor, the onus is on you, because at the end of the day, we may get financing for you, but you're going to have to own and run that property. And if somebody moves out, you're going to have to make sure that you're able to get somebody in that space to cover that mortgage payment every single month, right?
Right.
So the key thing is education. I always push them towards more and more education. Along with me educating them, I want them to become self-educated. And there's hundreds and hundreds of books. There's hundreds and hundreds of podcasts and YouTubes and things like that I can I can refer them to become educated. And so the more educated they are, the better investor they're going to be. So that's the first thing. Obviously, we can take a look. The numbers are the numbers. I can look at the numbers, tell them where they're at, what they possibly could afford. Are they buying it to occupy it with their business and run part of it and release out part of it for their business? Great, let's do that. That way, the lease part will cover some of their debt service on their owner user part, and they have
Right.
a much less net effect on what it costs them to be in their space.
That is wonderful advice. And there are lots of real estate investment books, and some of them are more rah and cheer you on, but that's all right,
Sure.
because you need motivation in any aspect of your life. I think that's some of the I think those are some of the best parts of those books, is the very beginning where they motivate you. They
Sure.
motivate you about getting into real estate, but motivation is part of it. But also, there are really, like, there's a book, I'm not trying to recommend anything or not recommend, but it's 100 questions every first time home buyer should ask. That's one great book that's out there. If you're ever going to buy a home, buy that book, buy it and
Sure.
read it cover to cover, because and then there's also Dolph DeRoos and Rich Dad Poor Dad. They have a book called Real Estate Investing, and he goes through um they
You
go
know,
through
Dolph?
an analysis of commercial versus, I'm sorry, residential versus commercial, really multifamily versus commercial, and I think it's a very good read.
Yeah,
But those
beautiful.
type of books, go ahead. Have you heard about some of these books?
Oh yeah, I know Dolph very well personally.
Oh, you know him personally.
I do, yeah. Yeah, we've had lunches together.
Wow.
We've had many meals together, and plan on traveling together and doing some deals together. Some I've worked on some financing stuff for him, and we've been talking about doing some uh, seminars, possibly seminars around the world together. So that might be the
Awesome.
plan for the future. So yeah, he's here in Phoenix. Part of the year he is here in Phoenix, and Robert's here in Phoenix as well. So yes, I've had the opportunity to work with them and speak with both of them personally.
Well, help me get them on the podcast. I'm serious, because I just recommended his book out of the blue, and I really do. I think that's a really good book. I think he has a PhD, and it's and then just other books, and there's just a ton of books out there. Some are better than others, but and what you'll learn is, if you read enough of them, which I've done a lot of reading of these books, you'll just see many concepts repeated over and over, but that's okay. Once you start seeing concepts repeated over and over, that means you're understanding and you're recognizing, hey, I've read that before. And so
That's
it's a
right.
lot easier, I think, and smarter to read about other people's mistakes rather than making a big whopper yourself, when you could avoid it by just education, like you say.
That's right. That's right. And the key thing is, as an investor, the key thing is having a trusted group of advisors, both in the real estate side, like with you as the agent, as the real estate broker, and as me as the lender, as a commercial lender, commercial broker. Having trusted advisors that you trust, and they know that they have your best interest at hand, and they can help educate you on the best decisions to make. In the most part, at the end of the day, it's going to be the investor's decision to buy or not buy. But having a trusted, group of advisors that you surround yourself with, and that's what's
Yes.
anything. And as people that acquire a bunch of real estate, if you're in the fix and flip or the rehab, whether it's commercial or residential, if you're going to do that, you have to have a trusted group of construction contractors that are going to do the work
Yeah.
for you. You have to build a team. If you're going to be a big investor, if you want to invest in multiple properties and not just one or two, you're going to have to build a team of trusted advisors, people that you go to. It's going to streamline the work. It's going to increase the efficacy of your work that you do, and it's going to make you more efficient and probably more effective as an investor too.
Yes. And also, when you're doing this whole process, you need to remember, like, let's say there's Mr. Big down the street, and he owns a lot of property and all that. And you meet him, or you ask to see him, or meet him or her that own a lot of property. And if you ask them for advice, I think you'd be surprised if you ask somebody for advice, because so many people do not actually ask them for advice. Many people will just shy away or whatever, but many people who have been successful in real estate or in any endeavor in life are quite willing to give an individual that approaches them um, share their knowledge with them.
Sure, absolutely, absolutely, for sure.
And that's the goal. That's the goal of this podcast. It's more educational. I know, I do business and all that, but I have plenty of business. I do lots of work with my company and all that. But the goal is to educate and same with the articles that I write and all of that. These podcasts are designed to be educational, and I would like to continue the conversation with you, and about other topics, and I'd love to have you on for more. And the thing is, I want to respect your time and thank you for coming on. You've been a great guest. And
Sure. I appreciate the opportunity.
you said was there anything else you wanted to share with us? Was there an article or something you were talking about sharing?
No.
Or
It was the
okay.
article I shared with you regarding the office conversions is all. And the Dallas was like number 3 on the list there. So that's all.
Right. Well, it's going to be an exciting time ahead, and I was excited to have you on the podcast, and you've been a great guest, and thank you very much for attending.
Thank you, Robert. It's a pleasure. I appreciate the time.